This conference will now be recorded.
Good evening, ladies and gentlemen. This is Clueless Trading Frank. It's approximately 8:35 p.m. on November 10th, 2019. This is a Clueless Ape Trading Weekend Strategic Update, Market and Stocks webinar, like we always do. Precision forecasts and a whole bunch of good stuff that we talk about to prepare our members, free trial subscribers, and anyone out there who's going to be listening to this on our Google YouTube channel to prepare themselves for what's coming next. On that note, full disclosure, this is purely for financial education, not for any solicitation or advice, and we shall begin. So as I'm setting up the charts, we're going to go through the economic calendar coming up for this week. This is a pretty pivotal week for different reasons. Number one, the markets are, as we had predicted months ago, in some cases weeks ago, as you know, exactly as we had said, the markets hit new highs. And the markets will keep on making measured new highs, and that's the key word, measured new highs, not just a boom, another 500 point, 600 point type of move. I don't think that's going to happen in the near term before we get a quick tactical reset, i.e. a pullback, which is coming. And it will come early as Tuesday, Wednesday this week. So we're going to go over the reasons why. So saying all that, the markets are making measured new highs. Not every stock is making highs. There are a lot of great companies which are still way off the highs, which gives more fuel from a contrarian standpoint that the markets can continue to move higher. Because generally speaking, when you have more than 70% of overall stocks, S&P, NASDAQ, Dow Jones Industrial type of stocks, more than 70% of them making 52 weeks high, that's when you know pretty much that the markets are pretty much a serious top in the market, what we call a intermediate tradable top. So we're not there yet. I don't have the exact figures on top of my head, but I do not believe we have reached that 70% number yet. Over the near term, over the short term, yes, I mentioned this before and I'm mentioning it again. We are technically overbought. That means a quick 100, 200, 300 point type of drop is nothing to be feared, in my opinion, as long as the levels hold. And we're going to go through that both from the long and short term view on the markets, is a buyable dip. The markets are seasonally, as we all know, if you follow the old almanac, in a very strong period from November to April, generally speaking, or even from from actually October, to be honest with you. Once you cross over the hump in mid to late October, with all the accounting shenanigans that are encountered. That is the end of the fiscal year, primarily for US-based mutual funds, which are the 800 trillion plus dollar industry, or 800-pound gorilla. I don't quote me on that number, but they are huge, and it's the end of their fiscal year, October 31st. So once you cross that hump, you generally tend to see a short burst of money flowing into the market in all types of sectors. And that's exactly what's been going on. Saying all that, we have saying all that, as we go through the economic calendar, I'll show you 2 days which are going to be very critical for the markets in the coming week. Also keep in mind that we are winding down earnings seasons. More than 73% of companies that have announced earnings have beaten the lowered estimates. This is something I told you all before the earnings season started, about a month ago, that these analysts from Wall Street, who primarily dictate the estimates, have lowered the estimates to a point where these companies, unless they came out with much worse than feared numbers, the markets would take it and rally. And that's exactly what's been going on. It started off with Caterpillar in the early part of the earnings season. As you know, the stock got hit right after the earnings came out, and within a matter of 24 to 48 hours, turned around and kept on going higher. And look at Cat, so it's a prime example of a big cap Dow Jones Industrial Average, S&P 500 type of company, which told us that the market was ready to go higher. So there's a lot of factors. One of the most bullish factors between now and the end of the year has to do with Wall Street bonuses. People don't realize that most of the big shots on Wall Street overall, especially analysts and big institutional traders, get paid on bonuses. Their salaries are obviously very nice, but where they make the real big money is bonuses. Okay, so they have to show a nice P&L going and ending the fourth quarter, which would be end of December, as we all know. So generally speaking, Wall Street investment banks don't go out there and go on a rampage selling things, even though I will admit that last year was an aberration. We had the Christmas Eve massacre on December 24th, which dropped the Dow more than 600 points the night before Christmas, and that was unheard of. Now, as we get toward the latter part of December, you will see pressure on the overall markets, and I'm kind of looking forward a little bit, primarily for all kinds of tax-related harvesting, tax loss selling, and things like that. A lot of rebalancing at the end of the year. So the last week in December, generally speaking, is a highly volatile market, and I know venture to say that it probably will be a kind of a slightly down week. But going towards that period, you should expect to see that upward surge on the overall U.S. markets. Now, in between now and December is a long way. In between now and the end of the month is a long way. In these type of markets, it is it's really a day-to-day kind of thing when it comes to volatility. We're used to it. We don't always like it. I never like it. But then at the same time, it is something that has to be accepted. It's a fact of life. It's what I called years ago, like I said, I call it the new normal. This is the new normal of the world of machine-driven trading that we deal with. Very fast pullbacks, very sharp pull-ups. So we try to predict. We are using our Clue trading predictive analytics. We have been able to predict those type of moves and position ourselves correctly. Now, the other reason why the markets have a bullish bias has to do with positioning, which you guys probably know. I've talked about it, and you guys know that too. And positioning means that the large institutional funds, mutual funds, hedge funds primarily, are very underexposed to equities or risk assets, i.e. stocks. If you remember, less than a couple of weeks ago, all they were talking about was the end of the world because we're going to go into a recession. If you listen to my videos just look up my videos from a month ago, whatever, I stood by the ground from a larger macro perspective that the U.S. is far from a recession. There are certain slowdowns which were happening in certain areas, but we are far from a recession. And if you looked at some of the videos which talked about, and we're going to certainly look at it today, the 10-year government bond yield, which was crashing below at one point. At one point, it was below, I think, close to 1.4%, or I don't think it went below 1.4. We'll see. And according to Wall Street and every other pundit out there, it was the biggest canary in the coal mine, and that showed that the U.S. economy it dipped into a recession within a matter of months. But those are the fake signals that the market, sends you. And I'm not looking here to, as I always like to say, make you guys a PhD in Stanford, or Princeton economics or Harvard economics or University Booth School of Business economics. Those are the finest economics departments out there in the world. But I'm just trying to explain to you some of these basics of why the direct correlation between the 10-year government bond dipping to those lows, causing massive recession fear and causing money to flow into government bonds as a safe haven. Europe was already very negative on their yields. Explained all that in simple English in many of my previous webinars, where if you put in money in a bank, you'd get less back, what we call negative interest rates. negative yields. And some people said the U.S. might go into that. Hogwash. U.S. would never go into that. There would be enough stimulus put in the market to make sure U.S. economy that doesn't happen. But the point is that all that changed, and the U.S. 10-year government bond yield rallied the largest in God knows how many years in a short period of time, within a week to 10 days. We are currently at 1.933% on the TNX, or 10-year government bond yield. Now, keep this in mind here. I believe in my last webinar or the one before, I showed that if we reach certain levels, and we'll look at that chart tonight again, that the market will basically at that point have a short-term top. I'm talking the stock market. Because bond yields, as it approaches 2%, I'm talking about the 10-year government bond yield, which is directly correlated with all consumer lending rates, credit card rates, leasing rates for cars, all kinds of stuff, mortgage rates, obviously. If rates closing into 2%, because all of a sudden, good things are happening in the economy. President Trump is talking about phase one deal, which still has yet to be signed, but looks very likely, even though he made some negative comments on that regarding rolling back the tariffs that the Chinese have demanded. And according to China, President Trump will do, but he refuted that on Friday's comments. The fact is that all these things perked up inflationary figures, which caused the U.S. government bond to go higher. But as the U.S. government goes higher, all of a sudden you're going to see, and it's the same old routine that's been played out for the last 50 years, okay? That they're going to start talking about, and they've already started talking about, like, oh my God, what if yields keep on going higher? What's going to happen? That's going to crimp the rise in stocks. So we're going to look at what levels they're going to start talking about it big time, and the market will be in for a sharp, substantial pullback. Not a bear market, just a very sharp pullback. Excuse me. What's a very sharp pullback? A very sharp pullback, according to what we have very accurately determined, is anywhere from 600 to 1,000 points. It's like a 6.0 or 7 magnitude what do you call tremor, earthquake. All right. And anything more than 1,000 points in the Dow, it's like the whole world is falling apart, right? That's what they're going to say. But these are going to be things from a technical standpoint possible. So please keep that in mind as we move forward. We have come a long way. We have broken out like a monster. Longer term charts are still pointing higher. Short to medium term charts are pointing slightly lower. Okay, slightly lower. A small, what do you call, magnitude, let's say a 4.0 magnitude earthquake is 300 points on the Dow. A 6 magnitude earthquake is 600 points on the Dow, and anything more than that is like 800 to 1,000 points. But those, when it comes to individual stocks, tend to, where am I on the weekly? Okay, sorry. Tend to bring down stocks anywhere from 3 to 5 to 6%, and that's a lot, guys, right? That's a lot. Then all of a sudden you see Apple down at 240. You see, I'm talking about techs here, but you see things like Boeing down to 320, 330. Boeing did have some positive news over the weekend, by the way, regarding their 737 software fix. And a lot of big cap stocks which run the market higher tend to also fall accordingly. So anyway, let me just set this up as I'm speaking to you all. So we certainly have short-term worries, no question about it. Generally, these short-term worries are sparked off by, as we know, presidential comments, tweets, comments out of China, any slight delay or disruption on the signing of the phase one deal, Brexit issue regarding Europe, bond yield fears rising, rampant runaway rates always cause fear in the market. So just explain all that. What else? Political skirmishes and drama in Washington, D.C. regarding these impeachment hearings. These are all factors, macro factors that can affect the market anytime. All right, so just keep that in mind. On the positive side, we talked about the fact that Wall Street doesn't like to give up on their bonuses, not just Wall Street, but other institutions all around the country. And so they are going to try to maintain their positioning. The second, and not on a priority basis, but the second very important thing is most large institutional funds and such are very underpositioned. They are getting more exposed to stocks. That's the reason why you're seeing stocks really moving, especially the name brand ones. Look at our long-term swings like Anthem Healthcare, Humana, Regeneron, which I talked about just a week ago, and stock just went berserk, and it still got room to move. I told you that biotechs would be a very strong sector. It's a leading sector in this market. I was right on that, and I do believe that regardless of China, the Chinese trade talk disruptions and such, if it happens, biotechs are, in my opinion, a safer haven to be in because they are not directly tied in with China. So Humana, Anthem, United Healthcare, Medco, all these type of companies, and a slew of mid to small cap. Oh, and then the other ones like Vertex, we played that, Amgen. These are great plays. These are great plays. But the fact that so much institutional money has been pushed in it over a very short period of time might make them a little bit short-term overbought. Our charts show it, and over the intermediate term, they're still showing. Over the longer term, they're still showing they still have room to move because they're not even they're not that close to the 52-week highs. It's not like Apple making 52-week highs every day. These companies are far from that. But though they are also held hostage to, as you all know, political comments coming out of the Democratic side primarily, and also some Republicans regarding managing and trying to control government poking their nose into our private companies, which, as you know, I'm thoroughly against. So the point is that this is the weekly. So those are things obviously they have to deal with. Policy risks. Where's month? Let me look it up. I'm basically setting up the chart so we can basically go through. There it is. Perfect. Go through and revisit these charts that we talked about on one of the videos just within the past month and show you what we talked about and what happened. Keeping things in perspective and learning, even though you might have missed out on some really powerful trades or missed out on playing the market through the SPYs, QQQs, IWMs and such, primarily the SPY and the QQQ. It's always good to revisit this so you basically learn and apply the lessons learned of missing out of and understanding the bigger picture. Very important. So let me pull up the economic calendar, explain to you why this week is such an important week over the short term. I'm sure some of you already know what is happening on Tuesday. Well, I pull this up. Bingo. All right, very good. Are you guys all with me so far?
With you.
Okay, sounds good. 11:10. Okay, so this is where we start off. So starting off on Monday, tomorrow is Veterans Day, and bond markets are closed. So the credit markets will be closed, but the stock market is open. So you have muted trading. You don't have the bond guys on the other end to control the interest rate movements back and forth on all the credit markets, which is the 800-pound gorilla in the overall stock markets, right? Versus the younger cousin, the stocks, or the equity markets, which will play on their own. So tomorrow is Veterans Day. Tuesday we kick off with pretty much nothing in the morning, and then we have these two Fed speakers. But at 12 noon, ladies and gentlemen, President Trump will be speaking at the New York City Economic Forum. and you can bet that you are going to see some major volatility in the market on his comments. He will be, I believe he'll be taking limited questions from 2 moderators. That's what I read this weekend. And so I am going to say, one second. I'm trying to write this with this mouse. So President Trump will be speaking at the New York Economic Forum at 12 noon. I believe the markets will be quite volatile, and there will be, and if we run into another new high on the market before then, in my opinion, from a technical standpoint, expect to see a quick sharp pullback during the time that he's speaking, because those questions he's not, unless he openly says, nope, we have fully agreed to remove all tariffs or limited tariffs before we go into the phase 1 deal, things like that. The markets, if he does not validate that comment that China said that he's going to do, they said that last week, but the White House, if you notice, was very quiet about it. And that shows that there is obviously no direct agreement, or they're playing the hardcore poker game like we have been used to since in the past 2 years. So expect major volatility. And if the markets are technically overbought with all the indicators that we look at, then expect a pullback on Tuesday afternoon. We go into Wednesday, and Jerome Powell speaks at 11 a.m. So you got President Trump at 12 noon on Tuesday, and on Wednesday, November 13th, we have Jerome Powell. I expect Fed Chairman Powell to stick to his line, which has been very market friendly, as you know, that he's going to be, he feels that, just simple stuff, that he's going to promote he's going to cut rates or keep rates lower to promote economic growth till inflation picks up to a large degree. But he might be asked a question or two about the fact that rates are moving up so sharply over a short period of time, which we're going to look into that right after this section. What is his plan? So if he makes any sort of fumble, like he sometimes does with his answer, you can expect the markets to fall. Just for no reason, it'll just fall. That's the way it is, okay? If you guys have seen it, now accept it and be ready for it. And if he even hints that the rate cutting cycle might be coming to an end, the market will fall quite a bit. And then it's going to have a reflex rally. But I believe he's going to stick to his comments, stick to the balanced comments, and it'll be okay. But regardless of that, the machines will create artificial manipulated volatility on Tuesday and Wednesday. Then we get into Thursday, November 14th, and we have more Fed speakers: Charles Evans, John Williams. We have do we have another number on Wednesday, which is very important because these numbers are directly tied in with inflationary pressures in the economy, the consumer price index and the producer price index. This is the basket of goods that consumers buy. This is the basket of goods purchasing managers buy for raw materials that they buy to make the finished products, right? So the PPI and the CPI, if they go up a little bit, that's fine. If they go up a lot, not fine. That means the economy is overheating over the short term, which is not bad at all, because just 3 weeks ago, they're saying the economy is cooling down to the point we're going to fall into a deep, dark abyss. Now it's starting to overheat. There's a lot of, so like I said, so these two numbers are very important. These are numbers which gauge the measure of inflation. So the machines and the algorithmic high frequency trading black boxes will create volatility depending on those numbers. Then we go into Friday, and we go into retail sales. Very important. Retail sales, even if it's 80% or 70 to 80% of the U.S. GDP, gross domestic product, as you know very well, is U.S. consumers. We are a fanatically crazy nation of shoppers. We're the world's biggest shopping mall. That's the only reason why everyone sells into us. I mean, come on. If we didn't buy, why would they sell into us, right? think about that for a minute. It's not like you force yourself to buy. People, they don't have 2 cents in the bank and they go out there buying, cars and not necessarily houses, but clothes and electronic goods and everything, which is great because it keeps on pumping our the largest part of our income, which is known as the gross domestic product. But any drop in that, the markets will not like it, because that means the U.S. economy is, the overall economy is maybe hitting stall speed. And if inflation's picking up more and retail sales are falling, what's that economic term? I'm sure somebody knows it. It's called stagflation, okay? Where the economy slows down a bit, but inflation moves higher. That's not a good picture. I'm not saying that's the case, but I'm just telling you something. Google it sometimes. I think it's a cool word, stagflation, right? So, so bottom line is, we shall see. So aside from that, this is your week coming up. Now, the other thing, yes, we're going to talk about earnings in a second, Paul. Yes. So the other thing that is important from a calendar date wise, why this week will be generally turbulent or somewhat volatile, at least intraday, back and forth. The week might start off like this and then go like this, and this is pretty much what happens every week, and then shoot up, and then boom, you wake up in the morning, oh my god, we're down 400 points, and then end up here. So get ready for a rocky ride. That's all I'm saying. So what's the best way to manage it? 1, be extremely selective. 2, don't rush into trades. 3, keep position sizes somewhat small, and you're going to be fine. Keep a lot of cash on the side, and you're going to be fine. Take advantage of opportunities as they arrive, intraday and overnight. You're going to make some serious money. So that's the best way to manage it, to be honest with you. I repeat again, even to this day, 99.9%, as I like to say, of retail emotional investors still think the market goes up like this and comes down like this. It never happens like that. But the human mind is such a stubborn animal. That's how we're genetically built, that we refuse to accept that fact. We do here at Real Estate Trading. I know many of you have come around to understanding that. And as we go through the charts, it'll display itself to show you that nothing goes up in a straight line, nothing goes down in a straight line. So, but I still feel that many traders refuse to believe that because of that genetic stubbornness. So get off it, all right? Embrace volatility. Now, talking about earnings, at 2 major earnings, as Paul reminded us, I don't have the earnings list in front of me. Walmart is on Thursday. What else is so critical on Thursday, which we are net long?
NVIDIA.
Exactly. NVIDIA. So this is Thursday, and we're going to look at NVIDIA's chart too. This is Thursday, and we have NVIDIA on the chip side. After all, it is a chip company, even though the fastest growing aspect of their business. What is their fastest growing component of NVIDIA's business, aside from gaming chips?
Cryptocurrency.
Yeah, cryptocurrency.
Cars.
Yes, exactly. Cryptocurrency, because they make the fastest graphics chips to process those high-end machines, which make cryptocurrency. That is not. It was one of their fastest-growing business, but crypto is kind of a very volatile business, as you know. But yes, artificial intelligence for cars and for many other internet-related, what they call IoT devices, and 5G. NVIDIA has a very powerful program on the 5G technology side, and as we all know, that the 5G stocks have been doing extremely well. So NVIDIA is certainly going to be coming up with their numbers, and very critical. Then to gauge the health of the average American consumer, not the high end, but the Joe, just mom and pop, all of us included, love Walmart. You have Walmart on Thursday. We also have Cisco, and we have a couple of other companies that I will be putting out there. I had a list here somewhere printed out, but we have some important earnings coming out this week, which will gauge the health of the U.S. economy and overall picture. So these stocks are obviously heavy components. This is a big component of the NASDAQ 100 as well as SMH, Semiconductor Holders Index, the QQQ, and the overall tech side, chip side, and then we have Walmart on the retail side. So any big drop on any one of this, Walmart obviously has a direct effect on the Dow Jones Industrial Average. And so these two things have to be taken into account. So again, going back to it, President Trump on Tuesday at 12 noon at the New York Economic Club, and and Jerome Powell Jerome Powell at 11 a.m. Okay, so there we go. So yeah, Paul just put out a link on earnings. I use briefing.com for all my earnings stuff, but Paul just put up a link here, which I will copy and paste for all of you guys to. It's a StockTwits link. 1 second. Oh, I can copy and paste from there. Interesting. What if I do it like this? Okay, and there's thanks courtesy of Paul right there. If you want to take a quick glance of it and you don't have paid services to, for all this different stuff, you're right there. All right. So these are kind of selected names, but you guys can, November. These are just a few names. Obviously, doesn't show you the overall picture of all the earnings. These are some selected ones, right, Paul?
Yeah, I think they sort them by market cap.
Oh, okay, that's awesome. So here, 45 reporting. This is very helpful. Thank you. 163 reporting, 76 reporting, 71 companies reporting, and 3 reporting there. JD, JCPenney, and all that stuff. So here, yeah, if you just click that, it'll show up there. So feel free to copy this link, and you'll be good. Thank you, Paul. So so let's move on. So the next thing I wanted to show you guys to make good use of time is the infamous 10-year government bond yield. So I should say famous, I shouldn't say infamous. Whoa. So here we are on the daily on the government bond deal. These lines were drawn all the way when it was 1.426% on the fateful day of September 3rd, 2019, right there. I talked to you guys about this a few times on setting up the technical pattern. And as you can clearly see here, we have a definitive W pattern with a breakout. Any breakout over 1.982, it's going to hit the upper end and what we call pattern completion at roughly 2.2%. You can see that very clearly. Now, what does that mean to the average trader out there who is part of our tactical service here at Clueless Trading? What it means is when you see when you see the media, the financial media talking about where bond deals are going and these big the talking heads are saying, oh my God, what's going on? You know pretty much that the bonds have a fair shot to hit all the way the 200-day moving average. This is actually, 200-day moving average. It's broken out well above the 50-day moving average at this point and hit the higher level of 2.2% or 2.153% to be exact. What it really means for for a tactical trader here at Clueless Trading and anyone else out there who's listening is that as we are approaching these levels, the market is basically will start to form a significant top. Right after this, we're going to look at the S&P 500 and see where that significant top would be. I've shown that clearly on my real-time Twitter feed, including the last chart that I put out there. I do apologize. I had a very busy business engagement on Friday, which took longer than expected, so I was AWOL. But end of the day, I put it out there with showing a max upside on the E-minis at 3,114. So we're going to look at that. That's not too far away. But the bottom line is we are approaching this pink line here or magenta line. That's the 150-day moving average used extensively by many quant-based hedge funds. That's how I know about it. And once you break out over the 150-day at 1.982%, you can possibly get up there. Now, in the meantime, we have broken out over the neckline. There's your neckline right there. And we broke out over that neckline 2 days in a row, Thursday and Friday. That neckline was 1.907% or 1.91%. So the next major neckline comes into play. Well, there is one here, which was the breakdown level, and that breakdown level on the 10-year government bond is 2.04%. Remember, you just have to move the decimal point one over. 2.04%. And the final, not the final, but still a very pivotal pattern completion happens at 2.15%. Believe me, we cross over 2% on the 10-year government bond deal, the markets are not going to necessarily like it. Okay? Just letting you know, because at that point, technically, if it's breaking out like that, that means you're buying a 10-year government bond at, let's say, 2 or 2.1% becomes a better tactical bet for the large funds, quant funds, if you want to look at it, than sitting in a highly volatile S&P 500 yield, which I believe is around 2.2% right now. All right, so it becomes comparable. In other words, bonds become competitive to stocks. When it was at 1.4%, why would you sit in a government bond earning you 1.4% when you could buy the S&P 500 yield or any S&P 500 basket, SPX, basket through all these different instruments at 2+%? Think about that for a minute. So basically, this is what happened. And you don't want the behemoth, the credit market, especially the sovereign credit market or government bond market, which is the safest asset in the world, if you hold it to maturity, and which has never missed on a payment. If it's going to give you 2%, why would you risk your money? I'm not saying everybody rushes out. I'm saying just in general, why would you rush out and buy a risky stock, which can fluctuate 5, 6, 7, 8%, and give you heart attacks, every couple of days, while you can sit, why would you sit in highly volatile S&P SPX basket earning 2.2% while I don't have the exact number in front of me, but somewhere in that range, when you could buy a comparable basket of bonds, the safest asset in the world, at 2%. So you don't want bonds to become a competitor to stocks. So this is what generally happens. Let's move on to stocks here. So far, you guys are good? Any questions, Dominic?
No questions.
Okay, no problem, sir. Just asking. So before we get into the nitty-gritty of the structured charts, let me show you some of the more proprietary stuff here, and this has to do with the SPX 533. People who do the advanced coaching sessions, or you can actually you don't need to even do the advanced coaching session. In my past videos, I've explained this, but there's a lot of things that here that I look at a glance to see whether or not this rally is coming to an end. When you look at in very simplistic terms, very simple. The stochastics are overbought, but I don't see a point down yet. Right there. So this is fine. This is the RSI. However, RSI here at this point is approaching 90. Generally, when it stays over 90, it's a max of 1, 2, or 3 days. It stays over 90 before it has a quick pullback. Just so you know, that's the way it is. RSI gets overbought. You want to buy it below 30 and sell it over 70 or 80. It's now at 90. Every single time that we have stayed over an extended period of time, i.e. a whole bunch of trading days, you generally tend to get a pullback every single time. Now, whether the pullbacks are going to be thousands of points or whether they're going to be a shallow pullback, which generally has been the case recently, remains to be seen. I do not think we are in for 1,000, 2,000 point pullback unless the whole China deal falls about between now and the end of the year. So this is pretty okay right now, even though we are overbought. We are seeing the MACD, which started off its journey as the market climbed. It went totally in the green and basically is moving sideways. So that's fine. So this is your daily chart on the SPX 533. So nothing here is telling us anything is technically damaging. So far so good. I'm going to get into some details today, a very technical session. Let's look at the weekly. The weekly tells us at a glance, tells me at a glance whether or not this market is about to falter. Nothing here is showing me the market's about to falter. The weekly chart, which is more of the away from the short-term gyrations and all that stuff, is telling us this market is going to basically do another is going to create another short genocide. What does that mean? That basically means the hardcore quant funds and the hardcore short traders who are always calling for the demise of the U.S. market to make money are in for another total ambush. Now, why do I say that? I say that because of what I see. This has been a very, very reliable longer term picture. For short term trading, these charts mean nothing. Okay, but I'm telling you from a longer term perspective, these are very powerful charts. They have been correct almost 100% of the time, literally 90 to 100% of the time over the last 12 years I've been looking at it. Now, that doesn't mean I've been able to use this as a trading vehicle, but it at least allowed me to see whether my bias should be bullish or bearish. These are proprietary charts that you cannot replicate, by the way. I mean, you can replicate it in a different way, but if anyone wants to do that, just let me know and I'll basically provide them the exact link. You can try adding that link to your URL and see if it comes up, but I'm not quite sure. So saying all that, this is why I think when the market generally, and this is kind of a June pattern that's going on, we fell very hard and then we turned in June, and the histograms went from 3 negative bars. The MACD went from 3 negative bars to going positive. 1, 2, 3, 4, 5. On the 5th week and on the 6th week, the bar basically hit a top and then the market pulled back at the end of July going into August. All right. So the way I'm looking at it is I'm not looking for, once it goes positive, 1, 2, 3, 4, 5, 6 is a pretty long stretch of time. All right. But here at this point, even though we have rallied for 5th weeks in a row, right? 1, 2, 3, 4, 5. When you look to see how many weeks we've rallied with the MACD in the green column, all right, over 0, it's only the 2nd week. So what does that tell me? That tells me that overall speaking, we could have another 4 weeks, which kind of makes sense, which brings us into mid-December, another 4 to 6 weeks of the market basically creating a substantial top before the next big drop. I mean, really big drop. All right. Now, I consider a 6 to 8% a big drop, 10% very big drop. All right. So this is telling me this is moving along sideways quite well. The stochastics both have gaping mouths. In other words, they're really moving beautifully higher. These are the stochastics, and that's why reaching the 3100 to 3150 level is not a stretch of imagination. I think you guys can see that clearly. And the bars, the second bar positive, I believe there has to be at least another 2 to 3, at least another 1 to 3 of these bars, generally speaking, looking at historical precedent from a technical historical precedent, not the calendar, almanac, and all that stuff, that we could have another 2 to 4 weeks of upward movement in between sharp intraday volatility. Am I clear on this?
Absolutely.
Okay, so let's take a look at the NIMO, the McClellan Oscillator, and see what's going on with this. The McClellan Oscillator is very dependent and held hostage to intraday volatility. That's the reason why the McClellan Oscillator went negative on Friday, and right now is the stochastics are pointing down, which tells us we might be in for a slightly lower open in the morning. Okay, and we might do the opposite. We might be weak going into Monday, and then on Tuesday, President Trump could rally the markets, or we could go up, or we could be weak Monday and Tuesday, and then rally rally very strongly going into Wednesday. But I believe that the McClellan Oscillator right now, to me, is telling us we are getting into a little bit of Like, remember, the markets, I just had a quick glance at the market a couple of times, obviously, as I was dealing with my business matter. So the thing is, the markets, end of the day, had a very sharp rally. We're going to look at that in our charts. That was a big algo program that went in there and just pushed the market into the green because they wanted to print the week in the green. That's why they did it. It's called what? You guys know the term. What are they called old days? It's called painting the tape, okay? They painted the tape. In this case, the algorithmic high-frequency trading black boxes painted the tape and brought everything green. NASDAQ was up 40. All of a sudden, Dow Jones is up 6. Russell 2000 up 5. S&P 500 up 7.9. NASDAQ 100 up 36. Right in the last hour of trading. It's called painting the tape, all right? So they painted the tape, fine. This is what I'm looking at without you guys having to use a magnifying glass this is going to do a double bottom like this, and then the market rallies. So the market, again, by the end of the week, in my opinion, will rally before the end of the week and higher. In between, volatility. Get ready for it. So so far, nothing in these pictures is showing any major breakdown. This worries me a bit. The MACD is now creating expanding lower bars. You can see that. Now, if it becomes like this, then you get to that 600, 800 point type of drop like it happened at the end of September, early October. All right? Do I expect that? I have no frigging clue. I can't say that from looking at this. But if we do start expanding on the MACD, and this is refreshed at the end of every day, this is not a real-time chart, then that means more trouble is yet to come. And that will only be propagated by one simple big elephant in the room. US-China phase 1 deal. They start getting into a fist fight again, markets will drop. Simple. Keep it simple. So that's it. Now, now we dive into our charts. Bingo. Bingo. We cover the TNX. Let's take a look at the S&P 500. What is the first thing that I notice? What is the upper end of the Bollinger? 3,107.05. That's roughly how many points from here? 19 and 7, 26 points. 26 S&P handles times 8, 208 points, right? Just looking quick back of the napkin calculation from where we closed at 3081.59 to the upper end of this green ribbon, the upper Bollinger on the daily is 3106. If I'm correct, that's roughly 25, 26 points, correct? That's 25 points?
Yeah.
Okay, so how do you translate that in the Dow? Simple. You multiply that by 8, roughly 8, 7 or 8. So if you multiply 25 by 8, you arrive at 200 points. So give or take 200 to 200 and roughly around 200 points. That's the max upside we have on the Dow Jones Industrial Average, which is A-okay with me because personally, just letting you know, I want to be positioned with all of you together, right? So we can make some money on the short side and at least buy the market 3 to 4% cheaper. Who knows? Maybe within a week. Do not forget, we are coming into the middle of the month. Mark my words. Paul is new, so he's going to be listening to this for the first time, but he's heard a lot of my older videos. God bless you, man. So I wouldn't know if I wanted to hear some of my older videos. I'm just kidding. Is the fact as we approach the middle of the month, as we approach the 15th, and the 15th is Friday. As we approach, give or take plus minus 2 or 3 days, approaching the 15th, the markets almost 80% of the time, if not more, have a vicious move down intraday, and then you can buy it. So as we approach the middle of the month, just the way as we approach the Wednesdays, right? It seems to be a reset period. I believe it'll be the same this week. It could be a complete miss on Walmart numbers. It could be a complete blowout, crappy numbers on Nvidia. It could be President Trump mentioning the fact that he's still very skeptical of giving the Chinese any rollback on the tariffs that they requested, or additional tariffs that they requested. It could be Chairman Jerome Powell misspeaking again and fumbling like he's done a few times. All these are risk factors. Just remember that very clearly. All right. So 200 points max on the top side is where I expect the market to be. I'm not saying necessarily this week, maybe, by next week or towards the end of the month. I believe that November will end on a strong note, but we're going to see some quick, sharp pullbacks along the way. Just warning you guys all. So saying all that, so that's what the upper Bollinger is showing. Now remember, this upper Bollinger is not a static line. It will keep on moving if the candles keep on pushing it higher, right? Candles keep on pushing it higher. So this one will not remain at 3107. If the market's basically, if the candle expands again over the next day or two, then this will be up at 313 or 314, right? 3,114. So it'll expand. Now, a couple of things are happening here, which you guys all simply need to understand on a short-term basis. You cannot use daily charts for short-term trading. You need to use the 1 hour, the 4 hour, the 30 minute, the 15 minutes for short-term trading. But this gives us a very clear picture. You got to mix this in from a technical perspective with the shorter-term charts to get an idea where we stand. So this is where I think we stand. Everything here is extremely bullish. We had a rising wedge that was drawn months ago, okay? Literally months ago, back in August. That rising wedge has been penetrated higher, is a bust a move. Walked you guys through it. You have a rise, this is an, ascending triangle and a rising wedge. The dotted line is a rising wedge, okay? And the white line is ascending triangle. So you got, here's your AT or ascending triangle. This is pretty serious stuff here, okay? This is where the only reason these things happen, not because, us little pikers are going out there trading options. These things happen because big institutional money is being forced into the market or on their own volition stepping into the markets because overall macro global economic conditions have improved. 10-year government bonds are rising, showing no recession. This is the reason why you get macro breakouts, ladies and gentlemen. It doesn't matter what the pikers on Stock Twits or the pikers here at Clueless A Trading, what I think or you think. This is a fact. This is where the elephants are moving. You're reading the footsteps, except we told you how to read the footsteps before it was going to happen. So think, learn, apply. Remember what we say in trading and in life. It's not where you're coming from. It's where you're going. So even you might have missed out and not reached your potential. I know I didn't, even though I got some killer trades to show. But I didn't reach my peak performance, close to it. So do I look back? No, I look forward to see what I can do better and how I can not repeat some silly mistakes that have been done. A human makes mistakes. Even algos make major mistakes. So, but a successful human takes that and turns it into a positive. You look at a negative stress or a negative moment and turn it into a positive action. So again, don't want to be Tony Robbins, as I like to say, but just letting you guys know. So, so the ascending triangle broke out. It's very bullish. And this is one that is coming in from last year, coming in from a long time, coming in from all the way back here. Multi-year ascending triangle broken out. You have a rising wedge, which generally, when you reach the top of the rising wedge, you're supposed to have one of these. Every time that we reach this top, we pull back, right? Top of the rising wedge. This is what rising wedges look like. This is where all the monkeys on a hot tin roof, all the analysts, all the so-called pundits, all the retail traders, oh my God, oh, the market's can't do anything, oh yeah, we're gonna crash and burn, boom, breaks out. If you are a short fund with $3 billion shorting the spiders, you're right now panicking. You're panicking. Okay? Just the way longs panic when you have these pullbacks and you get a concerted, systematic, sell at all costs, throw the baby out of the bathwater type of selling. So this is what's happening here at this point. You might want to call this, I call it wave 5, the fear of missing out because you weren't in there. All right. So wave 5 can stretch forward. You know, this could be looked on as a wave 5. Okay, it can go on for a couple of months. So I'm not saying it's going to be a one-way straight line up, but this looks a lot like this. What happened between June and August. So anyway, so you have this ascending triangle breakout confirmed. You have a rising wedge breakout confirmed. So technically, very bullish. I'm going to show you the bullish points, and then I'm going to show you short term, and that's great for the bulls too, why we should pull back a little bit. Because remember, all those trades that you all missed, lots of trades I missed. Okay, why wouldn't I would love to be, I'd like to have the markets reset a bit or pull back a little so I could buy them again. So what's wrong with that? You should be excited. You don't always have to make money on a pullback. You can make money on buying this tactical low as it bounces again. So let's look at the stochastics. Is this any way or form telling you the markets are going to crash? Come on. I told you before, just because you get overbought above 80 doesn't mean you have to crash and burn. You could have intraday pullbacks that get bought. Futures right now are down 8.5 points. I bet you there's a lot of chatter in all the different trading forums, stock trades and stuff included, like, oh, here we go, here we go. They're going to get smacked again if they are not active traders overnight. Because it's the same old story. This is the more of the bigger pictures telling you we're going sideways, and that's a very powerful signal. Very powerful signal. Steady and sideways. Look at that. I read some articles over the weekend very quickly because I was so tied up with some stuff that I'm doing. And these guys are saying this could be the bulls. There's certain like real technical pictures of bulls like saying this could be the start of the next grand bull market. I'm like, oh my Lord. Like, I'm not even subscribing to that stuff. And who the hell am I? You know, but I'm just saying that's like, oh my God. But it's possible because you still have trillions of dollars. I think in combined 9 trillion, but overall maybe $4 to $6 trillion that's still sitting on the sidelines in the bond market. And then now they're starting to rush out of the bond market. Only a trickle has come out of the multi-trillion-dollar credit market and coming into stocks. What's going to happen if the economy and this China deal works out? They'll be like, oh my Lord. So yeah, it can happen. Remember, it's not where you're coming from, it's where you're going. So look at this. I don't need to explain anything. This is serious stuff. So I'm going to draw one more line here in the S&P. Now, and then I'm going to explain to you the short-term bearish implication of moving too fast. If you move too fast, too quick, and you know what I'm going to say, away from the moving averages, which is the highways, the 34 and the 50. The 50 on the daily hasn't even crossed over the 34 yet. When the 50 crosses over the 34, you can rest assured this market's going a lot higher. I mean, 1,000 points? Yeah. All right. Dow Jones hits 30,000 by December 31st. Hey, it can happen. Telling you right now. End the year in a monumental note. And President Trump's re-election bid is confirmed at that point. I'm serious. Dow 30,000? I don't care what political affiliation you are. You're like, that's it. I'm voting for it. That's it. It's over. He's the best economic magician ever. All right? So I'm telling you right now, this kind of big macro talk mixed in with the with technicals. I've talked about a few webinars over the past couple of years, right after President Trump's election, right after Brexit, right after this or that, and it's been dead right. I myself am making a concerted effort to follow my own precision forecast to a degree that I should, and not get swayed by the intraday volatility that comes about and that in many cases messes with our heads. So, saying all that, these are the highways that we travel in, right? So now we are getting. Let's do the quick math here. We'll do it on my quick Dollar General calculator. Just kidding. Yes, this calculator. How old is this? I think I bought it for $4, like 10 years ago. It's still working. Doesn't even have a name on it. It's just one of those little ones. You know, Dominic? I'm trying to find a name in the back.
I have old junk calculators that still work too.
Yeah, this one's the best. I banged on it. I screamed at it. I threw it out on the floor. Like, what the hell? The trade was going right. And it's a solar one. So it gets off my fancy desktop lamps and stuff. And it's always on. Middle of the night. Oh man, let me add up. 1 + 1 = 3. Okay, just kidding. So let's do this here. What's this number, guys? The 50-day moving average right now is at 29.90. Let's take it off from where we are. We closed at 30. I'm rounding it off. 30.82, right? That is 92 points. Are you guys with me so far?
Yep.
Okay. This is a simple back of the napkin thing that I've done for many years, and it's been right almost to, I'm not going to say it's right exactly to the point, but give or take a few S&P points, I've been dead right. Now, when we sold off hard, what's the most? Let's look back at here, okay? Because this reminds me, this pattern is what we are going through right now. Not this. This, ladies and gentlemen. Okay? We have a triple top breakout, the serious stuff, old-fashioned way, triple top breakout. There was a little bit of vacillation here for 4 days, and I told you guys we're going higher, and this is exactly what it's doing. So this reminds me of this, which had some sharp 1, 2, 3, 4 type of 4-day type of pullbacks, but just rushed forward. So let's do the math here. 50-day moving average. Dominic, can you read me the number on the right side, please?
50-day, what is that, 29.90, 62?
No, the one here. What's that number? 2870, 2871. Okay, so 2871, and then all hell broke loose, and we went down to the ultimate testing of the 150-day moving average, which is when things got really scary. Like, you break the 150-day moving average, you're much more room to fall. But anyway, that's the past. So let's talk about what's coming. What's that number? 2743? Yeah, 2743. You got to look at the number on this side here, obviously. So 27, let's take this out. The low was 2730. Okay, 2730. So that's 141 points. Are you guys with me so far?
Yeah.
Okay, 141. This cost erased. We said now we are up 92 points, right? From the 50-day moving average, right? Guys, this is simple stuff, but you got to be with me on this one, all right? So you know. So 92 points, we are above the 50-day moving average. Yes or no?
Yes.
Yep.
Okay, so if you do a simple math, if we can fall 100, these are extreme scenarios, 141 points lower, why can't we go 141 points higher off the 50-day moving average to wipe out a significant amount of quantitative systematic funds, what they call, what's the term they use? CTAs, they call them, commodity trading accounts, okay? Which constantly short or long the markets, like, So if we what's 141 minus 92? 141 minus 92 to be exact is 49
Like
points.
50? Yeah.
Yes, like 50. So 49. So basically 49 points. We could possibly, based on a measured move of what happened back in June, because I believe that is the pattern that we're going through right now. Okay. Because we failed here. So bottom line is, now that we're broken out, we could go another 49 points multiplied by an extreme 8. We have another 400 or 392 points. I'm going to write it here. Look at here. Okay, we have 392. Let's call it 400 points on the Dow on this move. Now, when you think of 400 points on the Dow, we could get that done in November, no problem. And the markets would hit a substantial top before we have a pullback in the first part of December or so. So just keep that in mind, okay? We are basically at this point, the standard deviation is rising rapidly. So that means we're getting away faster and quicker away from the 50 and the 34-day moving averages. That means the market's getting technically overbought. So this is the standard procedure, replicates itself 100% of the time in the market. You do not need to be some sort of Stanford rocket scientist or some guru on all the trading platforms to tell you that. Just letting you guys know that simple rule of the thumb. All right. So we are getting quite overbought. But there's room to move. Now, here is the other thing that the bears will never tell you or never notice, or even the bulls will fail to notice. Because remember, reading charts is like looking at a work of fine art. If you don't know what's going on, what the story behind it is, or you don't understand the patterns and blah, 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 you're just not going to get it. But it's quite easy. Let me move this down. Perfect. All right, there's your ascending wedge. It's cleaner. That one was the intermediate one. So if the 50, and please, this is not hard. Look how beautifully, and we talked about this last week. If the 50-day moving averages crosses over the 34, ladies and gentlemen, that is what happened here. Except the difference is, and this is where you need to use your eyes to look at things. Here, the 34-day moving average was pointing down, and the 50, and then the market reversed hard well before the crossover. Okay. Well, actually, no. The crossover happened on the second day of the pull-up. This was a 1,000-point type of day on the Dow. So, or 600, 700, 800-point type of day. This was a 1,000-point type of day right after Christmas. So anyway, the fact is pointing down here. Both the lines. This is severely bullish. Only thing that can damage this line like this is a complete failure or a short-term failure on the US-China trade deal. This, you have to look. The lines are going like this. This is much nicer than this. This is a smile, guys. This is the market smiling. Like, come on, buy me. This is when the market is frowning, right? There you go. This is what the moving averages are doing. This is what it did when the markets corrected big time earlier part of this year. This is when the market smiled a lot. And that's when almost everybody missed out on that run. You all remember that? After December 24th. So this is what's going on, guys. This is the longer term picture. Nothing to overanalyze. Now in between, sure, we can come back and retest the rising wedge. 3061, that's only 21 points. We could get that tomorrow. 21 points on the S&P is 160 points on the Dow. Who cares? What's important is this 20-day moving average, which is surging. And that is an important short-term support, 3029. Or call it 3033, which is the top of the ascending triangle. These are major support levels. So if they break that, they're going to come back and retest the 50-day moving average, which no one's going to like. And I'm going to short for sure. Quick shorts, because I'm not going to go bed with a nice fat short position and wake up the next morning blown up because markets opened up 30 points higher. Because that's what's been happening. That one time that I told, the last week, wasn't it last week? Yeah. It took me till 2 p.m. that day to make some money on those shorts because there was that quick sharp pullback. It was a total loss in the first part of the day, but I didn't. I said, what the hell? It's a lottos, like keep it there. And then the lottos ratcheted. I've been so busy, I didn't get a chance to put it on Instagram. They ratcheted from 21 cents, 41 cents to 91 cents for 5 minutes. And then the market pulled up again. Right? So, That's another way to calculate where we're going. 1, 2. What's the number here? This is a trading range. Again, simple back of the napkin calculations. What is this? 2,800? Let's call it 2,820. Upper end of the range. 30-30. That's 130 points, right? The range? 110 points. What am I saying? 2,820 to 30-30 is, no, 200. I'm losing my head. If anyone's lost, just tell me, hey, you know, so I'd love to explain. That's 210 points. Are you guys with me, please? Yes? 210 point depth. So,
With you.
yeah, this happened, this took how many months? July, August, September, October, November. So it's 1, 2, 3, 4, right? It took 4 months for this range to break. Or you can say, yeah, 4 months. 4 months. So in 4 months' time, what does 4 months bring us into? December, January, February, March. This is making a lot of sense. I told you guys in one of my previous webinars, March is when we get the mother of all pullbacks. Okay? 4 months from now. So it'll take 4 months. If you add 210 to 30-30, it comes to 3240. You heard it here first. Play it back. And if I'm right, which I have been before, you say, oh man. Well, don't say, oh man, just try to follow it. That's all. So we are looking at 3240. So 3240 is somewhere here. In other words, all I did was take this trading range, 210 points, took 4 months to break out. So it'll take 4 months. If you add the 210 to this, you arrived at 3240. 3240 from where we are right now, 210 points times 8 is another roughly 1,680 Dow points. Okay, 1,680 Dow points. If you don't want to be an active trader, maybe you want to buy some stuff all the way out to March. Seriously. So 1,680 Dow points added to where we closed at on Friday is 29,361. Do you think that we go to 29,361? It sure can happen. We get phase 1 done, we get phase 2 down. This 29,361 will gravitate towards what, Dominic?
30.
Exactly. Round numbers, old-fashioned way, 30,000 Dow. Not by December, by March. It can happen, guys, all right? Nobody expects the bullish scenario. Everybody's playing defense. You guys are playing defense. I am playing defense. Am I going into these big earnings movers with tons of money shoved in? No. I'm buying puny amount of calls. Yeah, getting at 600% return, great. But how about if I put 20 calls in there instead of 1, 2, or 3? And you know how many of these big ones that I caught? You guys know that. So that's why I'm saying we're playing defense. Because instead of buying in a basket of massive earnings players or getting into the Nvidias and stuff, instead of buying 20, 30 calls at a pop of a 4, 5, 6, 7, 8 dollar things, hey, buying 30 calls, I'm buying a fraction of that. I am playing defense, and I've been the ultimate bull on the market and still am, a tactical bull. So what do you think is happening out there? They're all trying to short the market on every move. Think. Nobody's playing offense. When the majority start to play offense, that's when you know the market. That means big money has moved in from the sidelines and are fully vested, and the market's due for a correction. That CNN thing, we look at it once in a while, Dominic, the one that you sent me on text, okay? That is full hogwash. because they don't give you the actual reading. In my opinion, if somebody's saying on that CNN thing that he, you know, the greed poll basically that I show, I always show you the real thing and the actual reading. I'll show it to you right now. Short-term traders might be positioned a little bit too bullish, yes, but you're telling me right now is extreme greed. Do you see extreme greed in any of your souls or actions? Yes or no? Do you see extreme greed in any of your trading activity?
No.
Absolutely. I don't, you know, some of my top traders, not my top traders, like members of trading with big money, they're playing defense like me. I'm not in extreme greed. I'm in cautious greed. So the real number, Dominic, is somewhere here. This is the fake number. Extreme greed. My butt, extreme greed.
Well, I came across that and I was like, is this
No,
for
it's very
real or
good.
is
You see,
this people just nervous?
I show this once in a while. It's a good thing you reminded me, you know, because I remember when they showed we were up here. Look, you can feel it. You can feel that me as a professional who lives and breathes what's happening in the financial world. I don't hear any real bullish comments. I'm just starting to see some of these guys becoming bullish. So yeah, short term, we might be in a case, I explained that earlier on, where we could have a quick 300-400, but the longer term picture, no way. Extreme greed. Yeah, right. That's the reason why I'm only 30 to 40% of stock exposure in all the major institutional funds and stuff, which are lagging the market big time. Big time. And they're all now scrambling to get into these stocks, which have moved up 60, 70, 80% from the lows where they were selling. There is no extreme greed. That is a fake number. Now, saying all that, we could easily get a 300, 400, 500 point drop. That's a gift, but we're not in extreme greed. Okay, so now we covered this, no questions. So let's draw another line and see whether or not the 3,240 in the S&P 500 in the next 240 days, sorry, 120 days, if it's possible, technically. Let's try to see if any of these things match. That is your very large macro channel. Take it off here. That comes to 3,300. You notice how all I did was touch the tops of each other. It is mathematically so precise, all because, like I tell people, all because the machines are mathematical. That's the reason why these charts come out like this. Oh, 1 second. Okay, so is this right? Hold on. I'd like to be duplicate drawing trend line. Yeah, I'll take that. So what's this number here? 3323. If you really look at it, that's the overshoot to 30,000. Because just like Dominic said, you know, when I said, you know, where do you think it's going from 29, whatever, 361, you said 30,000. Well, that's exactly what happened. So we're at 3082. If we get to the top of this channel, a lot of the times it doesn't get to the top of the channel. Most of the times it does. If we get to 3325, that's 243 points, handles on the, let's keep on reverting back to blue. Okay, 243 points from where we are today. That's S&P handles, E-mini handles, S&P points. So SPX, that's 1,944 Dow Jones Industrial points. Dow Jones is at 27,681 as of Friday, plus 1944 is 29,625. Good enough. Okay. So that's a longer term projection going into the first quarter of 2020, which ends on March 31st or March 30th. of 2020. So I'm going to draw another line here, projecting out. That's not the one I'm looking for. So short term, I'm looking at 31.36 right there. Okay. 31.37 S&P 500, roughly about 50 points from here, or 52. That's another 400 points as a major short-term top. Draw another line. So 400 points is the max move that I see from this point. Another line, but it could, given this type of market, it could bust a move over there. I mean, over that. And this is going to be interesting, ladies and gentlemen. Watch. For people who are into technical charts and have made money off technical charts, are using technical charts to make money, this is exciting stuff. Otherwise, it's dry as hell. Okay, another rising wedge here, ladies and gentlemen, right? So I'm going to draw this in yellow. Put it as 2. Right there, okay? So let's look to see here. This is another rising wedge. There. So the top of that rising wedge is that 3,135 level that I talked about. Now, is it possible that it hits there and busts a move higher like it did here over this rising wedge, the dotted line? Sure, it could bust a move just like that. Or what would be the best is hit that level, pulls back, has to have some sort of technical reset, and that becomes a viable event right at the top of this dotted line, which is the larger macro rising wedge at 3,060. 3,060 would be a great buy level, in my opinion. Retest of 3030 would be a fantastic short term. This week would be a great buy point to load up a bit. Why? Because that was a triple top, and in my opinion, needs to get retested. So the 50 points from here times 8, 400 points would allow you to get into positions or play the spies, which you might have missed. All right. All clear on this?
Yeah.
Hey, Frank?
Yes, go ahead,
Frank?
Paul.
Yeah, it's Paul. I'm just wondering if we look back to what we looked at before, looking at February, March, where does the channel take us there?
I didn't understand your question.
Just assuming the market rises between now and March, what do those numbers are you?
I thought I explained all that. Were you? It's all
Yeah,
there. Yeah.
Just based on this chart, I'm just wondering where those channels end up being in March.
Yeah. So I just told you 3,324.
Like, are you? I mean, if you're able to move that chart over on the timeline, does it show? Does it confirm what we looked at before?
I really not understanding your question. So ask me. So I'm not understanding the question. Like this is the macro channel that I drew, and I said that if you look at it from a depth point and add 210 S&P points over to this, it took 4 months for this to break. I just explained all that a few minutes ago. So go ahead.
The part I'm just wondering is that timeline that only shows us till today, but what if we looked in the future just to see what those channels?
That timeline. Okay. Yeah, I see what you're saying. Well, I'm expecting the timeline to be 4 months, but how do you do the timeline stuff? I actually, like an idiot, I forgot. I know you can project out, so the chart shows here. Let me look at the weekly.
Yeah, usually you can just like hold down the left mouse on the empty area and move it to the left.
Change what? Which empty area? Tell me. Are you on a thing? Are you on a desktop?
I'm not on your program there, but
one second. Doesn't matter. I just gave you control of the mouse. Go ahead.
Okay. Okay, perfect. Oh, my system's not supported. I'm just on Chrome, so I guess I need a
Okay,
computer.
okay. No,
Yeah.
no, no problem. Okay, let me get you out of there. Otherwise, yeah, I can give. Okay, so pull what? I know there's a way to do it. I'm just trying to.
Hey, Frank, if you just put your mouse like in the black area there and just hold down the left mouse
What's
button.
1 second. What black
Okay.
area? Down here?
Yeah, or just like anywhere on the chart, but like not touching a line or something, just,
Okay,
you know,
yeah,
an
go
empty
ahead.
space.
And then?
And then hold down the left mouse button and then
Yeah.
drag it left, drag the mouse
No,
left.
that just
It
zooms.
doesn't?
That
Okay.
just, yeah, that just
Okay.
zooms the thing. I know what you're saying. I know there's a way to do it, and I'm trying to. Okay, zoom
Yeah.
in. Okay, where's the zoom out button? You see, I do this all the time, like zooming in, right?
Yeah.
So, but to zoom out, that's a very good point. I'm going to ask them tomorrow because right expansion settings.
Yeah, I think that, play around with that because that will probably.
No, change right expansion settings. Hold on. Aggregation time interval, aggregation scale. Keep time zoom. Okay, maybe that'll work. All right, let's see.
I do it on investing.com. I can drag it over and see the
Yeah,
empty
investing.
empty
Yeah, that's what
space.
we'll do. That's what we'll do on investing.com. Yeah, but I know there's a way to do it here, which would be very nice. Hold on. Weekly. So this is your weekly. How about horizontal cross? What? There should be a way where I'll. Oh, there. Oh no, but that's still not giving. That's kind of taking me back, but it's not letting me move forward. You know? Do you understand what I'm saying? Vertical
Yeah.
cross will let me just do this, but it's not letting me show the thing. Anyway, we're gonna do it on the other one. Just put cross. Okay, so we're good with this. But like I said, time frame is still gonna be around that March time frame. So just mark my words. It's not gonna be February. It's not gonna be January. It's gonna be March, in my opinion. Getting into the top of the thing. All right. So here is your monthly chart. Now we talked about this a while ago, and it now come true. And it wasn't easy. All right, they took you to mind-blowing things, days of churning, i.e., volatility, to get you there. So this one will answer your question. This is a major chart. We just broke out, and I was probably one of the only few guys. And Paul, you follow a lot of people, and I know you see a lot more, on the forum site. I don't know if anyone showed you this type of chart projecting out from a while ago. So so want you to look at this. So I had the arrow here showing that if we broke out, we're going to basically hit some upper channel that's going to blow people's mind. And that is exactly what happened here. Now we haven't, so let's move the arrows on. And I said if we had broken 2814, then we are going to hit the lower end of the channel. This is a multi-year channel going back to 2006. So this will answer your question. If we basically project out to 2020, okay, 2020, we said April. No, yeah, April 1st or end of March, it comes to here. Can't get any more accurate than that. See that? Right there. And that, ladies and gentlemen, happens to be 3,300, maybe 1 second, about 3,300. So in answer to your question, this is a monthly chart. So each month, let's look at it. Here's our answer. How many months? When you start a macro rally, like we started, let's look to see in previous occasions what it's done. In 2016, even before 2016, even before President Trump won, starting in February, We went up 1, 2, 3, 4, 5, 6, 7. We kept them. I mean, this was serious, and this is when he got elected, November, and it was a see you later story. Okay, so that was. This is not something that's replicated too many times. It's happened before in 2012 and stuff too, multi-month rallies. So keeping political jargon aside, markets don't care, honestly speaking. Short term they do, but markets don't care who's in power as long as they accommodate the markets. Okay, so when you look back at the history of the US stock markets, aside from the housing market crash created by gamblers in the housing market, created by all the CDOs, CMOs, all kinds of artificial synthetic derivatives created by Goldman Sachs and all those firms and sold to sovereign funds and stuff like that, that created the massive crash. Aside from that, markets had months and months of systematic rallies under whatever administration was in power. Yes or no?
Absolutely.
Absolutely. Yes. So that's why I say, let's not mix too much politics in the picture, because that was, if I remember correctly, President Obama's terms, right? So if he was in power and the markets could do this, can you imagine if these friendly, very business-friendly policies can do to the market under President Trump, whether he gets elected for the next 4 years or not? That's what I'm trying to say. People say, oh, Obama was such a socialist and this and that. So let's keep the politics aside. Then why the heck did the markets rally a gazillion percent? The market should have been doing this. So the point that I'm trying to make is that, generally speaking, financial markets are politically agnostic. Because if you look at the history of the US financial markets, they have done equally good under Democratic presidential presidents as well as Republican presidents. So keep that aside, all right? So that's what I'm saying. What I'm saying is in a bullish way. The President Trump's policies are brilliant. I said he's done amazing stuff for U.S. business, okay? Even though I don't like the fact that he pokes his nose too much into private, affairs. And I don't want, things could go wrong. He could poke a little bit too much into some of our largest corporations, and just because he doesn't like them politically, and start antitrust probes and crap, and the markets will be down 2,000 points, just like that. Boom, boom, done. Because that means you're trying to break them up, you're trying to make them look like pariahs, blah, blah, blah. And that's what socialists and communist dictators do. So hopefully President Trump's team does not take that path just because you don't like the CEO of a certain company. Right? So that's a very big negative for the markets, believe me. But in general, markets don't care. Markets don't care if it's a Republican or a Democrat, as long as they don't go nutsy. Because the president alone can have all the policies they want. Elizabeth Warren, she wants to socialize everything. She's a very smart lady. Don't underestimate her. Might not like her, but she's very smart. So you don't think she's talking to Wall Street in between her big talk about socializing this and that? Of course she is. She's playing a game. She's playing a game to get attention, just the way Donald plays games to get attention. She's very smart. Would I vote for her? No. But do I think that the markets are going to collapse and just die right after she gets elected? No. Because what? She has the power to unravel everything? No. Unless there are all the socialistic, left-leaning Democrats all take power, all take control of the House and Senate, Congress and Senate, and start changing rules one left another, then they'll be out of a job because the U.S. economy will collapse. But that doesn't happen. The machinery doesn't change. The system never changes, guys. Elizabeth Warren gets elected, maybe the market drops 10%. Then they rally because they realize she's really not going to do anything dramatic. Same crap happened when Obama got elected. The markets fell a bit and then rallied like nobody's business. So wake up. So saying all that, this is serious stuff here. This is, let's count the number of months. So if we look back since 2018, when we had the dramatic drops, we had 1, 2, 3, 4, 5, 6 months of a rally. Then we just felt like nobody's business, like everything fell apart, okay, in early 2018. After that, we rallied 1, 2, 3, 4. Then things was getting really shaky. The China trade war, all this was fine. I told you this was an inverse head and shoulder, and now exactly it's trying to break the neckline and stay above 98, close to 100. It can move sideways. It moved sideways here after President Trump got elected. It moved sideways for years when Obama was in power, despite all the talk that that he was going to demolish U.S. business. Look at that, how many years the market moved above the 80 line on the RSI. Exactly. And the real power that hold is the Federal Reserve Bank of America. They're the ones who either break the economy or grow the economy and the markets. And Powell is a fantastic person. Janet Yellen, she was fantastic, even though she got a lot of heat. So what gives? So if we're going to count the 4 months, minimum 4 months type of thing, not mentioning this 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 gazillion months, forget all that stuff. So even if it's 4 months, we got 1 more month till we reach the upper end of this rising wedge. That brings us into December. Enjoy, gentlemen. And then we could get a nice sharp pullback that brings us into the 2800 level. That is known as what, Dominic? What is this pattern called?
Bear flag.
No, it's a bull flag, dude. What do you see a bear flag?
A bull flag, I mean, I'm sorry.
Bull flag. Now, the bull flag could be worth 3,000 points down. Remember that, but it's still a bull flag. So this line in the sand around 2800, 2820 is where the bull market survives. The bull survives till 2800. It breaks that, no longer bull. You can short the market all the way down to 2400, 2300. And you could make a lot of money on this pullback, but it's still a bull flag. A bear flag looks like this. Oh, President Bloomberg, what, killing the markets? Is that what you meant, Paul?
Yeah, I don't know.
You
I
are
don't think he has a chance.
you're out of your mind. Okay, I'm a New Yorker. All right, I don't care whether I vote for. I'm not voting for Bloomberg anyway. But you think that the markets are the man who is the epitome of Wall Street? You're thinking he's going to kill the stock market? Are you out of your mind?
I didn't
Paul?
say kill the stock market. I'm just throwing out his name there because it's funny.
Oh yeah, he's doing it, for his own thing. Remember, he's a very smart guy. Little Michael, as Trump likes to call him, is worth $58 billion made from nothing. So
Yeah.
he's not some idiot. Yeah, he won't get elected. He's Jewish. He's from New York. He's a liberal. You think he's going to get elected? I mean, yeah, who knows? I don't know.
No.
No, so that's what I'm saying. But does it make him? Would Wall Street cheer if he wins? Wall Street's going to go up 1,000 points. Wall Street's going to go up 1,000 points. It's Bloomberg of New York. So you guys think. You see, you Canadians, and most of you guys don't understand this. Bloomberg is all business. Business
Oh, I get that.
Business CEOs love him. So
Can you imagine if it was him against Trump? That would be great for the market.
Well, I would love that. That would be actually a great contest. We're in a democracy. We want to see some fighting, as long as it doesn't get too dirty. You think Bloomberg doesn't know how to fight? I mean, come on. You see, I haven't personally met him. I knew a couple of people who work with him. He's one of the shrewdest guys that ever. And so anyway, let's not get into political discussion, but I would like, in fact, you want to see a real nasty, UFC, hands off, Thai boxing fight. You want Warren and Trump in one room, because she's exactly the same like him. You seen her? She goes nutsy on her speeches. Exactly. And she knows her crap. So she's been the type who'll call. She'll be ready to. I would actually like to see it just for fun, because Trump, he knows how to. He knows how to do dirty fighting in the schoolyard, and she knows the same shit. She'll scratch his hair and stuff. She probably to pull his hair out. I mean, she's nuts.
Our politics up here in Canada are so boring.
You guys are different. You guys are very nutsy behind closed doors. We are nutsy outside doors. Everyone can see us. That's the difference between us, American and Canadians. Canadians are very nasty, and all kinds of weird stuff happen there, but it's always behind closed doors, so no one really knows it. Okay, I know your politics well. So, but yeah, so there you go. You know, so Elizabeth Warren and Trump on a debate and said, that's what I want to see. It's going to be fireworks because she ain't trying to wait for nothing. She's a nut. You know, you see their speeches and stuff. See, Bloomberg would probably not be able to match up because Trump just, you know, he'd be throwing out all kinds of like, you know, stuff, but he's prepared. But who knows? Who knows?
It'll
All
be
I'm telling
interesting.
you from a market standpoint, whoever wins, if the market earnings are good and the Federal Reserve is cooperative, we're going higher. As long as there's no major corporate policies and taxation that changes. That's the whole thing. Aside, they work it out. So saying all that, we got another month till we hit the upper end of the channel. Then if we around 3,200, from 3,200 we can pull back all the way down to test this level here, which is 2,954. So that's 300 points. So we could drop very well for tax selling and stuff that happened in the month of January. Because people deferred their selling, right, for tax benefits for the following year. So 300 times 8, we could drop 2,000 points and stuff in somewhere between January and February. But till then, I think we're pretty good. And in between, there will be little pullbacks and stuff. All right, guys, let's move on. This has been very entertaining. This is your short-term picture, short-term overbought. Internals are all good. These lines always get hit. So 3063, test of the triple top breakout at 3030. All these are in the works. Will happen. Don't freak out. If we start breaking and starting a bad bullish, this is a bad, red, ugly, bullish, bearish candle towards the 50-day, that means something else is going wrong. Okay, so I'll be monitoring that very closely. What's this? This is your daily. Futures are down about 7. Again, we are quite overstretched on a short-term basis from the standard deviation standpoint, so we could very easily come back and test the 30-35, 30-40 level. Everything else here is surging. This is where you're seeing the elephants step in, and people are refusing to look. They're refusing to look. It's like they all missed out on the big trade. Now they're all hoping for a 10,000 point drop. That's the feeling you get out there when I look out and check out a couple of trading forums. Whichever the case, we have to be selective on our stocks. This is your short-term picture, the 1 hour chart. So far, we have a double top. We have an inverse, we have a head and shoulder with a line at 3060, right there, 3063. This one, 3054, and the big one, which we do not want to break, can retest. We retested it quite a few times, is 3030. And which is normal because that's your big bad breakout that you got. But this is happening, okay? 36. This will happen within the next 48 hours. I think we're going to drop about 100, 200 points before or after for Wednesday. Most probably after Wednesday. This is your short-term ultimate precision trading chart. I don't care whether you're a futures trader, SPY trader, or any type of trader. You got to follow this chart. I told you guys about the Fibonacci retracement right there, and it broke above that. The Fibonacci extension, which has been shown to happen in this type of powerful bullish breakouts, is at, and this is from the lows of the Halloween low. The crash on Halloween right there on the 31st. Like, oh my God, the boogeyman's in your room. This is what we call a Fibonacci extension, Dominic, and that is at 3,124. So all the numbers are matching on all different fronts. Do I think it gets there? I think so. But what's the line in the sand? Want everyone to understand this? What's the line in the sand? Wow, we've been going for an hour and a half now. Wow, today was fun. Didn't even realize it. What's this big dotted line, Dominic?
That's a 50% Fibonacci.
That's right. Thank you. Want to remind everybody what Dominic just reiterated. This is the Fib 50. Make it stylish. Hey, honey, what's your, like walk over and say, what's your name? Well, I'm Fib 50. What's yours? All right. So you're Fib 50, you're James Bond. So you do not want to break the Fib 50. And when you break above the Fib Fibonacci 50 level, see you later. When the markets are very overstretched, they will always come back and retest the Fib 50, but that is not a correct Fib 50. Why? Because this was drawn before we broke out. So let me correct it, adjust it. There. So now the Fibonacci 50 level, which is extreme support, is at 3060 or 3059. How beautiful is that? Didn't we just talk about 3060 on the other chart? Right? See how these numbers all match? I can assure you we will test 3060. And I hope it happens the earlier part of the week so we have a strong finish to the week, or if we pull back after, because we are getting close to the 15, we have to be prepared. But the Fibonacci 50, just the way it got taken out from the big crash down, it will be, in my opinion, has a high probability of a retest. So that means 160 points in the down from here to here. In between, there are different Fibonacci levels that will act as support. First support you're going to have is 3073, 10 S&P handles, E-mini handles from here. Okay? That might happen as early as tomorrow morning. So these things are great for traders, because once you make friends with these charts, and it doesn't take long, because my charts are pretty friendly. They want to be friends with you. You just have to say yes. You just have to say, yes, I'd like to be friendly to my, with my tactical friends. Seriously, I'm not kidding. All right? Be friendly with these charts and they will reward you back. Now, if I correct that and then move the Fibonacci extension, that's 3144 or thereabouts on the S&P 500, give or take a few points. So everything is fine. Everything is fine. When I look at this, nothing to be really scared about. So this is your short-term chart you can use all the time. Now, let me draw one thing here. This was a megaphone pattern which we broke out, and we just broke out of it. So we can draw another megaphone here, like this. And this one, I don't know if I can draw that megaphone. Yeah, I actually, this is not really a megaphone. That's too steep down. So here, 3105. So all this will determine how your trades do on the other side, depending if the trades are market moving trades, and if they're trades which don't move with the market, that's a different story. This is another great 15-minute chart anyone can use for their benefit. This is what happened on Friday while I was away. Markets hit a low, left shoulder, right shoulder, and bang, straight into the close. Now, this is what the markets are doing, down 7 points. As long as we hold this level here on a very short-term basis, then we are going to hit the highs again. Or we have big support levels here. This was the gap that the markets needed to hold, and that's exactly what it did. So can we head back towards the gap? That's, again, 3064. Yes. All right, any questions? Because I got to wrap up.
I'm good.
All right, sounds good, man. So very interesting session. Thank you for all the great questions from Mike, from Paul and Dominic. Let's make this week happen. Let's do some earnings. Let's get Walmart up there. NVIDIA. Oh, we didn't look at NVIDIA. God, quick. Now, NVIDIA is also, ladies and gentlemen, somewhat, not somewhat, it's also very reliant on Chinese stuff. Now, another thing that the talk that President Trump might give a break on selective sales back and forth, imports and exports from Huawei. Oh, I finally pronounced the name right. Yeah, do you know what that's going to do for tech stocks? That'll be like, holy moly, because Micron, NVIDIA, and a lot of other American companies did do a lot of business. And Huawei is one of the world leader in 5G technology. So if they can have a meeting of minds saying, okay, we'll let you in a little bit, not too much. And the Huawei CEO apparently said he's more than willing to meet President Trump, and President Trump is playing the cards right with China, and so far being very strategic about the deal making. Then we're good. So NVIDIA broke out of the range. We talked about this on the last couple of webinars, right? So what's that range here? That range is 194. Lower end of the range is 124. Ladies and gentlemen, 50 points. NVIDIA, can it go up to 250? Yes, it can. If NVIDIA says business is so bad because of this tariff war, and they lowered their projections and stuff, we are going straight back to 165, where I'll buy it again. We already know what the stock can do if when things are really bad. We already know that 165, worst case scenario, which is not good, 130. We already know when things are really bad. Now that things are pretty positive on the trade front, and look at all these other tech companies which have come out and zoomed through the roof. Qorvo, right? The one name that comes to mind. Even Tech Data turned, not Tech Data, what do you call it? Trade Desk turned around like a monster on Friday. That's another reversal play. After being down 30 points, it was up 10 points, and then ended the day up 5. I mean, think about that. That means they're willing buyers. They're looking ahead. So if NVIDIA breaks out, it'll be good for 20 plus points. So buying a few calls, a few $100, hey, you got to risk it. If you don't, then stock goes up 20, you'll be like, oh, another one that I missed, So please try to do it. It's your life, whatever you want to do. But so far, I like it. Internals are fine. In fact, very fine. There's a lot of accumulation going on. We can see it through this beautiful full stochastic. That is very beautiful, actually. Okay, McClellan Oscillator is fine. And what's really beautiful is the MACD. This is very nice. This is very nice. What can I say? This is like, honey, I'm going to marry you nice, all right? So there you go. This is very nice. So let's see. I'm good with it. Even if the stock falls after hours because these machines are like pick on one little thing, like, oh, the CEO, had a cold, boom, it's like drops in. It's like wild what they do after hours, the machines. In my opinion, they'll still pick it up and run with it. That's my opinion. This is another stock I'd like to highlight. Didn't get a chance to put it out for you guys on Friday. Is Tech Data. Tech Data, this is the weekly, the daily. The daily, look how dramatic this was. Whoa, this was after hours. Stock goes from 194 straight down to 179. Whoa, end of the world. Whoa, right? Sorry, I gotta stop making these stupid noises. But it was pretty exciting. I managed to I was so tied up. On my iPhone, I actually just bought a few calls, the cheap ones, the 200 calls. They literally went from $1 to $8. Okay, I didn't get a chance to get in $1. I think I paid like $2. So this is what it did. It just went. Markets open. This was after hours. Markets opened here. I saw this bullish candle developing, and I saw this, because I was long it at a few calls in the basket at around 4. They plummeted down to 90 cents. Okay, it's not the end of the world. I had what was the other one which was going through the roof? I forget. It was because we had a basket of these calls, and next thing I know, I'm like rushing to get in. They won't give it to me. 150. I'm chasing it. 175. Finally, they give it to me at 2. I'm like, oh God, now they're gonna slam me. Boom, goes up to 3. This is what it did. It went from 179 to 206. Please do the math. That's 27 points. 27 points right off the bat from after hours, opened up around 186 straight up, and then did this. So you could have just played this for 15 minutes and just done your week. So when I look at this chart, this is good. Now, when I look at it from a 1-hour standpoint, it's very good. What is this pattern? Because that means big buyers stepped in, all big buy volume, shorts covered, and trade desk went on. What is this pattern?
Bull flag.
Huh?
Bull flag.
This is a bull flag. What is this pattern?
Oh, cup and handle.
There you go. So grab yourself a nice cup of tea or coffee and just buy it. Where's the long dated calls? The stock, again, in my opinion, will hit 205, and if it breaks up above that, expect to see the stock go back to 215. This is a serious company and a serious candidate for a major buyout. 2, read up on it. And no one knows it. Trade desk. So I like it. All right, guys. It was fun. It was real. Thank you for keeping my brain alive on a Sunday evening. And otherwise, I'd just be, I was so exhausted. I was just like, check out my favorite shows. But let's have a great evening, all right? Take care. Good night.
Thanks, Frank.
You too, sir.
Outside run game.